So we'll jump into the key findings now and walk you through some of those. So right out of the gate, one of the things that we realized from this survey is that there is a significant digital gap. So 62% of our respondents to this survey said that they do not rely on farm management information systems exclusively. I want to pause for a second and define that term FMIS because we're going to use that throughout. And I know that that term maybe means different things to different people. But for the purposes of this survey and what we're talking about here in this presentation, FMIS means absolutely every type of digital farm management and data collection / analysis software. So no matter how detailed it is or how all-encompassing it is, whether it's something like Climate Field View or it's something really specific for a very specific measurement on a very specific piece of equipment or something like that, we're lumping it all together into FMIS. So keep that in mind as we go through. 28% said that their primary data storage method is paper or some sort of analog to paper. And then most importantly, 50% of those who don't use digital have ever even considered transitioning to digital. So let's think about that for a second. 62% don't rely on software exclusively. 50% of those who don't use digital have ever even considered transitioning. That seems like a significant number of producers, and to not have ever even thought about going digital, that's a pretty scary statistic, I think, from my perspective at least. And we know that some operations maybe are ending with this generation and there's no one to take it on. So it's kind of just, seeing it out. But in operations that are going to continue on as they are, there needs to be a plan in place, and there needs to be a little bit more forward thinking about some of these things. We know that paper dashboard, having a notebook on the dashboard of your truck worked yesterday, and it might work today, but it's probably not going to work in the future, and certainly not work as well as it could or should. So we really need to be focused on these individuals and these operations who aren't thinking about digital, or who maybe haven't ever thought about digital just because they're scared or it doesn't apply to them or whatever. We need to think about how to make solutions work for those operations. So the next thing I want to call out here is the differences in marketing outlets. We ask everyone who took this survey what their primary marketing method is for their crop. What do they do with it? How do they sell it? Who do they sell it to? And we found that those who sell primarily to a food or fuel company are a little bit more likely to be using FMIS than others. So we need to look into this a little bit more before we make any conclusive statements, but we think that there's a way for buyers of crops, meaning food companies, fuel companies, feed companies, whoever is buying the grain or the product from the producer, to empower the producer to transition into more digital data management to help with that transparency throughout the supply chain. So again, we don't want to make any conclusive statements today, but this is something that we're looking into because it seems like there might be not only incentivization, but pressure that can be applied from downstream in the supply chain. I'm going to switch to this slide now, which is a little bit of a graphic on some of the barriers to collecting data. So we ask specifically, what barriers do you face in collecting more data than you are now? I want you to pay special attention to the very top and the very bottom of this graphic. So you'll see that the least selected barrier is that there is no benefit to collecting more than I already am, or the belief that there is no benefit to collecting more than I already am. So I guess to look at that another way, 75% of the respondents here, or 77% of the respondents here believe that there is benefit to collecting more data than they already are, right? That's pretty huge. That's a good thing. We want them to see that benefit and to believe that that benefit is there. Down at the bottom, the biggest barriers you'll see are cost, training or understanding, equipment, and then time, data connectivity, things like that. These are more outside barriers that it's a lot harder to address without some sort of outside support or outside the farm anyway, infrastructure to help. So thinking about these barriers to adoption, Another question we ask is that with cost barriers addressed, if cost was of no issue to you or no problem, or you had access to the capital, whatever, would you increase your precision technology? Or would you start or increase the use of your precision farm tech? And I mean, almost unanimously, people said yes, which I don't think should be a surprise to anyone, but that does reinforce how significant the cost barrier is here. And on the one hand, if we want and need producers moving into a more precision and more digital world, we have to realize the real barrier that they're facing in terms of capital that these things cost to set up and to get going. And however we circumvent that issue, I think is going to work. I don't know that there's one silver bullet solution to it, but it is something that we need to think about, and we need to be working towards understanding how we can reduce these capital barriers that producers are claiming to face. So here's a really interesting finding that is probably going to be relevant to this group as well. So trusted advisors, right? That's anyone from your agronomist, your retailer staff, whoever the farmer identifies as a trusted advisor. We know that they play a critical role in adoption, but what we found is that those who are supporting the digital transition are sparse. So only 52% of producers who took this survey said that they have a trusted advisor who could answer questions related to FMIS and digital ag. The way we asked this was, hey, producer, if you had a question tomorrow about digital ag or precision or FMIS or whatever, do you have someone that you could call immediately to ask that question to? Do you have a trusted advisor who could help you answer that question? And only 52% said yes. So that's right out of the gate. That's a huge problem, because if there's not enough trusted advisors, if not every trusted advisor, to be honest, is able to answer questions or to support the transition into a digital environment, then that's going to be right out of the gate just another huge barrier that we have to deal with. In last year's survey, we asked a slightly different question. We asked if their advisor had suggested they increase their data collection in the past year, and only half said that they had. So 2 years in a row, about half of the advisors to the producers taking the survey have either not been able to support or answer questions related to digital transition, or are not pushing digital transition on their own. Both of those things are a fairly significant issue if we're thinking that we need to move more farms into a digital environment. But significantly, those who do have such an advisor available to them are 24% more likely to be using FMIS. So we do see a pretty solid link between the two. When the advisor network system is able to support and is supporting producers, they're more likely to be doing it. So we need to figure out how, as an industry, can we empower and incentivize the trusted advisor network to be able to support producers in their digital transition. I
wanted to talk about some of our key activities had to do with a new set of revised ratios. So back in 1991, when this original guideline was issued, there were a total of 16 financial measures / ratios. Now, word is that when that original committee met back in the late 80s, early 90s, they had everybody write down their top, I think it was their top 10 ratios or something, and they aggregated all of that. And there were, again, this is what I've heard, what I've been told, I wasn't there, that there were 200 different ratios or metrics that came in. So I don't know, that seems like an awfully big number. So, but even if it's half that, that's a big number. So the fact that they were able to get that down to 16, I think is pretty amazing. And from what I gather, there was a lot of time spent narrowing these down, a lot of late night discussions to get that to those final 16. But this organization is always trying to be, be relevant, be sure that we're addressing the needs of what's going on. And so we added five of these ratios measures in 2007. So we were up to 21. So in the last 14 years or so, we have received lots of comments that there are too many ratios, or they're too repetitive, or they're not the ones that we want. So what we have voted on at the annual meeting here is to reduce these to 13. So we're basically getting rid of 8 of these. We are going to use this concept of alternative ratios. And so you could say, well, really there are 17 because you're giving an alternate, but the way we're presenting it, there really are only 13. You could use an alternate instead of one of the 13. It does remove what we're calling measures, or some of the number items that we have. So for instance, we used to have a financial measure called working capital, net farm income, EBITDA, about 3 of them related to repayment capacity. Those are gone. They're discussed, and there is a special mention of working capital, but because those numbers all are either coming off of the balance sheet, the income statement, or our repayment capacity, we just refer the user to that, and the ratios are all about combining numbers, right? And dividing those one into another generally, and then the resulting interpretation. So what we've ended up with are 2 liquidity ratios. Current ratio has been there all along, and working capital as a percent of gross revenues is a ratio that was added in 2007. So that allows us to size how much liquidity we want, or how much we should have. So current ratio is probably the most common ratio that is used, but it doesn't tell us how much working capital. If I have a target of 20% working capital, 20% of gross revenue, well, I know my gross revenue, I know what my target working capital should be. An alternate is working capital as a percent of operating expense. That's a common one that lenders use. On the solvency side, we're down to just liabilities as a percent of assets, or debt to assets. And so the other 2 that we used to have are alternate ratios. USDA, land grant universities, academics, I've seen a lot use liability or debt to assets. Equity to assets is generally used by farm credit, and debt to equity tends to be used by commercial lenders. So we expect that people will pick one. On the profitability side, we've kept return on assets, return on equity, operating profit margin, and we took some liberty and we moved something called asset turnover ratio from efficiency and put it in profitability, since we're really using those 4 together really as part of the DuPont financial analysis to really understand profitability. On the repayment capacity side, we've got 2. We have something called total coverage, or debt coverage ratio. That is a new ratio. So the difference between what we've had in the past, which was our term debt coverage ratio, and the debt coverage ratio is simply operating interest. That's the only difference. So operating interest is now in both the numerator and the denominator. It's becoming more and more common. It's been I think a bane for many analysts to try and split out the term and interest portion. And so it's still an alternate, but the debt coverage ratio is now the recommended. And then the replacement coverage ratio just extends our repayment capacity to include replacement of our capital asset base. And then we have 4 more ratios related to our financial efficiency: operating expense, depreciation, interest, and earnings before interest and tax as a percent of gross revenue. So those have not changed. We did receive lots of comments from people. We had lots of new ratios recommended, but when it came to voting and debating this, this was the 13 that we ended up with. So if you have a particular ratio that you would like, join the council, come on to the technical committee, And you can be the flag bearer for that one. And we'll, because we certainly do revise these over time as needs come up. So I don't know how many of you are familiar with all of these guidelines, and I don't want to linger on this, but here is a listing of the categories of the original 16. It may be a bit small, so I apologize for that. And I will be getting you a copy of these slides so you can actually see it in more detail. But it lays out the original 16 by grouping. Then it shows you the 2007 ratios and what happened here. You can see the new ones coming on. For instance, the working capital as a percent of gross revenue. You can see quite a bit of changes in the capital or the repayment capacity section. And then what we're proposing for January 22 are the green items. The blue are going to be alternates, and then the yellow is a special discussion of working capital when we're talking about the working capital as a percent of revenue. So that's where we are. This has probably taken 2 years to get to this. We had more people on the financial ratios subcommittee than we had on the technical committee. It's been the most popular. The financial ratios just really seem to be popular. We've had a lot of interest, lots of discussion. It almost seems like we had lots of stops and starts, but we're finally there. So we got a few minutes left. I want to kind of turn here just kind of at the end and talk about what are some of the key recommendations with departures. And I alluded to this a little bit ago with a few of those, but this is just more of a broader list of what we see that are not always used.
And as we start looking at what the opportunities can be, that's where we can start defining what our value proposition is. And a value proposition really is about what you're going to produce or what you're going to do, who are your customers, and what is that relative price. And sometimes for a grain farmer, that feels like it's, you have to overthinking. And sometimes it's really, I want to be a low-cost producer producing grains and oil seeds for international export, achieving premium prices. So some can be more complicated than that, but it can be as simple as that as well. And so as we define our value proposition, we also take a look at what is the vision of our company? Where is it that we want to be in 10 years? I think, sometimes we had a vision that was out there further, but lots of things change. And so we kind of take a look at that 10 to 15 years and say, what is our vision for our company? And we do have an exercise that kind of helps people kind of put that together, because sometimes it seems overwhelming and trying to figure out what is it, where do we want to be in that 10 to 15 years. We also take a look at core values. We spend actually quite a bit more time on this, simply because core values really contribute to your how you manage, what you're going to do and what you're not going to do in your business. It impacts your culture. Core values is super important. I had an opportunity when I took a group to Germany in 2019, and we went through the Lemken factory where they build cultivators. And this is a multi-generational company. And the most recent generation was there to do a presentation for us. And she said, what the employees know is the core values. They can recite the core values. It's the core values that drive that business.
I don't have it all figured out. I can see John in the back, Brian, Norm, good to see you guys. Thanks for having me here. What I'd like to do is, besides tell some funny jokes, which no one ever laughs at, I'm going to try and give a little bit of a view on some of the stuff we're seeing in the industry, and then maybe a little update on the company, because I think it's kind of interesting to see what's happening out there. Some of this you guys probably know intimately. Worst case, it forces a conversation. I think it was, Brian, I don't know, correct me if I'm wrong, but 6 months ago, there was a survey, and there's like 6,000 different ag tech companies. I mean, it's some crazy number of innovative companies, whether it be technology, digital, agronomic, machinery, autonomous vehicles, just go through the list. And, I'm an entrepreneur, so and as I think most of you are, so that's inspiring, right? A lot of innovation, a lot of opportunity to bring efficiency and do more with less, right? What's happening is we're now moving through a cycle where things are starting to mature. And I think it was Winston Churchill that said, we're coming to the end of the beginning, right? We're coming to the end of the beginning. And so with that, you're starting to see companies coming out of nowhere, starting to build big platforms in ag and food. This is a beautiful chart I stole from somewhere, I forget where, but the adoption curve is real, right? This is a technology adoption curve that was actually originally researched in Wisconsin, university research with dairy farmers around who are the enthusiasts that are early. They usually spend more money, make a lot of mistakes, but they are sometimes ahead of the curve. Then there's the visionaries that are trying to figure out, think of these as, the folks that were using AutoSteer 17 years ago before it became mainstream. And then there's this gap. And in that gap, a lot of companies, technology companies, fail because they maybe couldn't get to the point where the market really adopts. And I think one of the classic examples of this is AutoSteer, where over the 17 years before it got to 70% adoption, there was, I forget the number, 10 years where adoption was less than 7%. It's an interesting way to think about the opportunities that I think we're all looking for, which is how do we start to streamline, integrate, and really turn data from a chore into a value, right? How do we actually get a return on our knowledge investment?
I always say that we're going to talk about the shiny new syndrome, but sometimes barn visibility ends up being one of the best talking points at a cocktail party, but doesn't give you really margin. And so we focused our attention on going after margin, going after the cost of dysfunction, the $25 variation spread in cost of productions today. So our agenda, we'll talk about how to harvest margin through integration. We'll talk about the current state as from our perspective, margin, which is the objective. We'll talk about the future state. We're going to kind of go back to the future. Jason's going to take us through the journey of manufacturing to some of the same analytics that we're looking at today in pig production or crop production. And then we've got an implementation blueprint that we're developing, and as we're talking to customers and potential customers about what it takes to really integrate to drive margin. So one of the things that we talk about a lot, and we hear this a lot, particularly around the context of sensors, barn control. I got so much information coming at me, I don't even know what to do with it. And so we love this quote by Herman Simon from Carnegie Mellon that talks about the wealth of information creates a poverty of attention. And so in our estimation, attention equals margin. And particularly in the pig business, sometimes attention has to happen in 5 minutes, 10 minutes, 15 minutes, 12 hours, 24 hours. Something has to drive that decision and that attention, or there's going to be a margin, either a margin loss event or a margin capture event.
Logo at the middle, right? Where everything revolves around accounting. Everyone knows that. So the theory is relatively simple and certainly congruent with all these other presentations we've heard today, where we have terrestrial MASA or FBS as we know it, And then we spin a replication of the data up into the cloud. And then it's in a format where we can use API connections to hook into any of these management widgets or apps out here and do data transfer through APIs rather than the TA import export function or the Packer interface or the feed mill interfaces. So a faster, more seamless connection there. And then also utilize these already created cloud accounting widgets that are out there and available. If we can speak their language, we can tie that functionality on as well.